welcome to today's event. Thank you very much for joining me. Welcome to Avalon Invest, formerly Rowe Wealth Management. I'm excited to bring this to you today. I've been wanting to bring this to you all year long. International stocks, international equities became the strongest asset category. And that's kind of a huge alert for everybody. And it's one of those things that really very few people even see or listen to. And they really tend to miss out. I'm going to give you a couple of examples of the past. But before I get into that, let's just do the disclaimer. I want to make sure that everybody knows that this is for educational purposes only. Nothing should be considered a buy or sell recommendation. We are registered investment advisors here at Avalon. So we do have the registrations and the license to advise you one-on-one after you've filled out an investment advisor agreement with us. So in order for us to act as your investment advisor, you have to have first filled out an investment advisor agreement with us, and it'll all be documented. Of course, we can't give you individualized or personalized investment advice without knowing a lot about who you are. So, 90% of the introductory is getting to know you, getting to know what your comfort levels are, getting to know what kind of volatility you can withstand. And then what we do is we use relative strength methodology to invest in a way that you're comfortable with. So you can apply relative strength methodology to any asset categories, whether it's bonds or stocks or international stocks or commodities, whatever it is, you can use relative strength. It's a simple math calculation. It's really not rocket science, but it's something that's proven throughout history to outperform the benchmarks over and over again. All right, so without further ado, I know your time's valuable, so I'm gonna get right to it. I know that you can see the disclaimer on the screen. Right now, I'll ask you to take a moment to just grab a pen and paper, grab something to jot some notes down on. If you can, silence your phone, get rid of all the distractions. This is going to be, I'm not going to ask you to give us your credit card number at the end of this. This is just to show you what you need to know right now to make the largest, in my opinion, most likely largest risk-adjusted return, meaning for the amount of risk that you're taking, the biggest return on that risk. If you find that something is twice as volatile as you want it to be, you can just invest half as much money. What I'm saying is I think that you'll make more money even if you invest half as much money in international stocks. We'll dive into details soon, but please take a moment, grab a pen and paper. If not, prepare some sort of notes on the computer. So maybe like a Word document or something like that. I am a money manager here, and most investment advisory firms are not also money managers. They're just asset gatherers. So they will tell you that they have the best money managers on deck. It's very easy to look up who's got a nice track record or whatever. Most of the time, individual investors lose money, or I should say they underperform the benchmarks. And the reason is because of performance chasing. What we do here, I'm a money manager. I'm the chief investment officer of the firm. I'm the one who will be handling your money. I have created all the models, all the algorithms, rules-based investment approach. It's very different from other firms, and I'll get into that later. Without further ado, if your investment advisor does not have you invested in international stocks, you might want to think about getting some money over to us. All right, here's the hierarchy of categorization. Now, some of you know me very well. Some of you already understand this hierarchy and this categorization, this sort of framework that I teach. But I mean, at True Market Insiders, which is a completely separate firm, True Market Insiders is a subscription-based firm. It's a publisher. It's not an investment advisor. A lot of you know me from True Market Insiders. Avalon Invest, a completely different firm. It's a money management firm. It'd be the same thing like Elon Musk with Twitter and Tesla and SpaceX. On a slightly smaller scale, but you get the point. All right, glad to see everything is going okay. All right, if you do work with Avalon Invest, the cool thing, I want everybody, before I even get into this, because we're talking about the hierarchy and the categorization, right? The framework that I've been teaching for like 30 years, right? At Avalon Invest, we invest the same way I've been teaching you to invest, but we do it for you, and it's in a portfolio as opposed to one-off ideas. So you might subscribe to a service where I'm giving one-off ideas. We try to create as close to a model as we can, but because of the laws, there's just no way to really replicate what we would do at a money management firm. But it's the same concept, same framework. So a lot of the problems that people have when they follow me is I'll talk to you in the lingo that we speak, that you might be fluent in after a year of following me. I might talk to you about the 6 asset categories and the sectors within them. And that's all well and good. We're speaking the same language. But But then you go to your E-Trade account or your Thinkorswim platform, and they're not reporting it to you the same way that we discuss it. In other words, they're not reporting it to you in terms of 41 subsectors of the stock market. They're not reporting it to you in terms of 6 asset categories. You don't see that on your screen. So it might be hard for you to see what percentage of your portfolio is weighted in international stocks versus domestic versus commodities with the 41 subsectors and so forth. If you work with Avalon Invest, we will report this to you. And even if you have another investment advisor that starts that sub-advisor agreement with us, in other words, if you don't meet the minimum and you do it that way, we can still report your account to you. So, I mean, one of the best things that you can do, get on the same page. You know, we're not making predictions. We're just looking at what the data is telling us is the strongest. All right, let's keep this moving. All right. All right. So this is taken from the NASDAQ. It's an institutional website for NASDAQ, and Dorsey Wright, pretty big business, does a very good job at showing different asset categories and things like that. So what we have set up here are the 6 asset categories that we talk about from time to time. And that's the vertical on the left you could see there. So there are 6 asset categories. International stocks are at the top. All right. And the cool thing, if you look at the top left, International Equities is ranked number 1, and that's good to know. But is it ranked number 1 with a close second? You know, is it almost tied for first place? And the answer is no. You can see in the score here, the score says 243. It might be kind of tough to see, but it's in black, kind of with white font. Top left, under the words International Equities, you see it says 243. So you know just how much stronger it is than the other asset categories. It's not just ranked 1, 2, 3, 4, 5, 6, but in this case, we're showing you the entire score. Okay, and you'll note it's color coded also. So, you know, if looking at the score and you're trying to use your brain while you just recently woke up, maybe you're on the West Coast, you don't have to do that. Just think about the colors. Look at the top right part of this image. You see the strongest is the darker green, the weakest is the darker red. You can just squint your eyes, not even have your reading glasses on, and get a general idea for what's good and what's bad at this point. You can also learn a lot from this. I'm not going to get too deep into it, but if you look down at fixed income, you'll notice it's ranked number 5, and the sectors within fixed income, you can see that high yield, U.S. high yield is the strongest, and that has been getting stronger and stronger. Now, U.S. high yield within the fixed income asset category, that's the riskiest of the 8 groups that we track. Okay, so it is the strongest. And what that tells you is that there's a lot of interest in high risk stuff. It means that the fear has gone away. If you look at the right side of that horizontal row, you'll see short-term treasuries are the weakest. Long-term treasuries are the second weakest. There's no interest in safety right now. They don't want safety. So that, the bond market is generally smarter than the stock market. But just look at the horizontal. If you're not, it took me a year to adjust my eyes to all this. So if it's going over your head, don't worry. Also, this is going to be recorded. But don't worry, if this is going over your head, it takes a little while, but once you learn the language, you get really good at it, and you'll be able to, it's like living in a new country and learning a new language sometimes, but you'll be able to navigate it like a neighborhood that you've lived in for a long time. The good news is you don't have to keep learning new stuff all the time. If you use this framework, you only have to learn one thing for the rest of your life. You just get better and better at that one thing. So 6 asset classes or asset categories. International equities is ranked number 1. Cash is number 2. Domestic equities is number 3. Commodities is number 4, and so forth. I'll say a couple more things about this before we move forward. From doing this forever, I know what the most common questions are. First of all, the understanding that's important to have is that what you're looking at on your screen right now is a long-term picture. So you see that the asset classes have their rankings. You can see that the sectors have their rankings, but you might wonder if this changes from day to day, or if this changes from week to week, or maybe zooming out changes from month to month. So think of a cruise ship turning around versus a very small boat that can zig and zag, right? This is what we base money management on. This, and we also go a little bit intermediate term. So our focus when we're managing people's money is longer intermediate term. So somewhere between intermediate term and long term. We look at long-term indicators. We look at intermediate term indicators. We will not day trade your nest egg. We don't day trade your net worth. We have a couple of models that are a little bit more aggressive for people that want a lot more action. That's another story. I'm not here to talk about that today. Today I'm talking about how International Equities has gotten very strong. It's long-term, stronger than everything else. So on a bigger picture basis, International Equities is the strongest. All right. Something else I'm going to point your attention to, if you look at domestic equities there, the score is 194. Now look at the arrow. See the arrow on that domestic equities all the way on the left is an up arrow. That means domestic equities has been bumping up in strength lately. All right. Now just going to get into that a little bit later. All right. With all that being said, I just told you that there are 6 major asset categories. There are 6 asset classes is another word for it. Here's a study that shows what would have happened if you look at the blue line. The blue line is if we always kept you in the number 1 asset class or the number 1 ranked asset category. So you look here, International Equities is ranked number 1. So imagine if we just completely invested you in International Equities, like 100% of your portfolio were in International Equities because it's ranked number 1. And there are times where it moves out of first place. But you'll find that whatever takes that number 1 ranking holds that spot for a very long time, oftentimes years and years. Most of the time, it's going to be in place for a very long time. I'm going to show you details on that in a second. So if we just kept you invested only in whichever one of those 6 is the number 1 asset class, this is what you would be. This is what your performance would look like. Now, keep in mind, I'm just showing you asset classes in terms of the benchmark. We layer on top of that relative strength investing. So you're looking at the benchmark. So let's just say the number 1 asset class was US stocks. You would be invested in the S&P 500. But what I'm also telling you is the way that we go about investing in US stocks in this example would not be to buy you the S&P 500. It would be to buy you the strongest sectors in the US stock market. So it adds a layer of probability. It adds a layer of risk-adjusted returns. So this is just, this is pretty incredible performance, but this is just looking at in terms of benchmarks. All right, so the blue tells you what your account would have done if you're invested in the number 1 strongest asset class. And the purple shows if you were invested in only the number 2 asset class. Now, I'm sure you're all thinking the same thing. That's a pretty big difference, right? Because we started with, the $100,000, and over time, we ended up with about $430,000, something like that, with the first strongest asset. And then the purple, the second strongest, ends up with approximately $250,000. Very big difference. But we do keep you diversified among multiple asset classes, mainly because it helps us, I don't want to use the word control the volatility, but it helps us have a very good estimate on what your volatility level will be. And again, that's the most important thing, is that you're comfortable. So everybody sees charts like this and they say, put me in that thing. That's the thing that did the best. That would have made me the happiest at the end of this journey. But in reality, in practice, you probably would not have held on that long. You probably would have been scared at some point and jumped ship. So we diversify you in a particular way that fits your criteria and your comfort levels. And sure, we'll give up some returns for that. Fine. But in terms of risk-adjusted returns, we may not be giving up anything at all. It might even be better. Considering the volatility levels, you'll get maybe a lower absolute return, but if you have very small volatility, the risk-adjusted return is actually mathematically higher. All right, back to hierarchy categorizations. So you have your asset categories, 6 of them. We've covered that. There are sectors within them. And then within those sectors, you have subsectors. We're not going to cover that part today, okay? Like you guys know that we have 41 subsectors of the stock market that we follow at, True Market Insiders, again, completely separate company. We're not going to get into that today. We're going to stay a little bit more basic. So there's 3 levels to this. There's asset categories, of which there are 6. There are sectors within them. Depends which asset category we're talking about. There might be 8 sectors, 6 sectors, 11 sectors. And we're not going to cover the subsectors. So let me go back to this for a second. If you look at domestic equities, for example, this is the one that people are most familiar with. There are 11 sectors there. You can see basic materials is the strongest, 199, right? Financials is behind that. You can see the worst is communication services. This is not a measure of the sector ETFs. This is not the spiders that you might be used to. This is not a performance of the spiders or that, it's not the S&P 500 broken into 11 groups like those ETFs that everybody knows, XLK, XLY, XL this, XL that. That's not what this is. It's just the same categorization. They have the same names, basic materials. But it's a very, very complex study. It's a gigantic matrix. I'm not going to get into it right now. But just know that we have these basic sectors within the asset categories. And if you look at international equities, there are 6. So you can see emerging Europe is the strongest, Latin America second strongest, and then Europe developed. Asia Pacific emerging has pulled back a little bit, Asia Pacific developed, and so forth. All right, again, these are long-term strength calculations. This is telling you what is actually happening, not what we think is going to happen. A lot of people think that if you just buy the thing that got beaten up so much that you're going to do well in the market, right? What this does, this study here, it just divided the stock market. It just looked at all the stocks in the stock market and organized it from the best performing stock all the way down to the worst performing stock. And then it studied the top 10% best performers. So every month you look at the stock market and you say, what are the top 10 best performing stocks? Top 10%. So if this were looking at 10,000 stocks, you would have one model all the way on the left there, model number 1. And that would invest in the top 10%. So out of 10,000 stocks, that would be a model of 1,000 stocks. And every single month, it would just check again and say, all right, this month, we're going to, again, own the top 10% best performing over the last 6 months. So it looks at a 6-month performance and it says, what's the best performers? Whatever was doing really well over the last 6 months, we want to own that this month. It just repeats that process every single month. And if you look all the way to the right side, well, almost the second from the right, you'll see the lowest, right? It was model number 10. That invests in the worst performing stocks over the previous 6 months, rebalancing every single month. This basically dispels a myth. A lot of people think that you just have to buy what's way oversold. But if something has been pounded down, if the price has just been hammered, there's a reason for that. It's because it's dog crap, and you don't want to invest in dog crap. You want to invest in what's the strongest parts of the market. That's why relative strength works. Okay, back to the asset class, because we're talking hierarchies. You're looking at that blue line again. That is the number 1 strongest asset class. Right now happens to be international stocks. It's 1 out of 6. This, also taken from NASDAQ, our friends at Dorsey Wright. You could see it looks a little bit different, but this shows the intermediate term as opposed to the long term. It's a little bit shorter term in nature. So, we might see changes here, right? In this longer term thing, right? Like the cruise ship makes a turn, right? When trends change, not very often. And within these trends, you see kind of little zigzags. It's a little bit shorter term. It's the intermediate term trend, all right? It's not as short as a short term trend. It's intermediate and a little bit of maybe even a longish term trend, all right? Again, the reason we manage your money using bigger trends is because they're the more reliable, they're the more stable. We don't want to be day trading your account. We're not going to get in at the bottom. We're not going to get out at the top. 100% of the time, you're going to see us not sell at the top or buy at the bottom. We wait until it's a confirmed trend, and those trends tend to stay intact for a long time. What that means is when you're happy with us as a client, you're going to be happy for long stretches of time. And it's going to be a huge relief because a lot of the time the world's running around with their hair on fire and you're just kind of happy that you're with us. And that lasts a long time. Also, because we subscribe to this technique, to this martial art, to this religion, what we do, every now and then it's going to underperform. And when it underperforms, you're going to not like us that much. Okay. So you're going to, especially if you just started with us and we happen to go into one of these little patterns, it can be 3 months. It can be up to 9 months. Very rarely is it more than 6, 7, 8, 9 months. Like every several decades, it'll be maybe a year and a half. But you'll go through periods of underperformance. And if you work with Avalon, our goal as your investment advisor representative is to make sure that when it does underperform, it underperforms in a way that you're comfortable with. So you're going to have the highest returns if you can withstand the most volatility. But the thing is, catch 22, if you're in this highly volatile thing, you might sell at the bottom. We don't want you to do that. So our goal is to really understand what your comfort level is. And I mean, if you're outperforming the benchmarks, no one's better than you, all right? You don't have to outperform the benchmarks 5, 10 times. It's better that you actually stick with it. You digest your dinner nicely. You're not thinking of us when you should be out enjoying your life. All right, but in a little bit more of a shorter term here, you see Europe as the strongest score. S&P 500 has the second strongest score, and recently that wasn't the case. S&P 500 was much lower, but you can see, so the shorter term zigs and zags, the S&P is actually catching up to international. You can see there's a direction. Again, you don't have to know all this. I just want you guys to know that we know this. But Europe, is at 384, and it had jumped 2.96 points up to 384. That's a huge jump. That means it was down under a 1. So it had a huge jump. S&P 500, it had been the strongest, but Europe came up much stronger. All right, but you can see S&P, it's up, not as big as a jump. If you look at the third row, you look at Pacific Basin excluding Japan, so basically excluding developed. You can see also another high score with also another huge leap. So that shows you that these are things that are a little bit newer, but they are the leaders, they are the strongest. It's like a speedboat surpassing a cruise ship. It's like, all right, you're the little riskier one, but you could see that the leaps that it's made. All the models that we manage are rules-based models. So that means that, we have programs that are telling us what should be done with your model. They're proprietary. We don't share them with anybody. They're worth zillions of dollars. Relative strength readings are not a prediction. We're not predicting anything. The only way it's kind of a prediction is a simple fact. Sir Isaac Newton, a body in motion stays in motion until interrupted, and I forget how the rest of it goes, but a body in motion stays in motion. Whatever the trend has recently been in terms of price performance, in terms of the world, whatever it's recently been up to this point is probably what it's going to be in the near term and intermediate term future. All the time. In other words, trends last a long time, reversals seldom happen. And once the reversal happens, then a new trend begins. Our job is to adjust to those trends. Okay, so are relative strength readings a prediction? They're not a prediction, or they're not a forecast. Relative strength readings actually show us what is happening right now at the moment. So relative strength readings are telling you this is what's happening right now. When relative strength is the strongest, like right now, international stocks is the strongest. When a relative strength reading is strongest, it means you would rather have your money stored in that investment vehicle. You'd rather own international stocks than anything else right now. You'd be better off. It's that simple. I mean, I can explain all the ins and outs. It get really wonky and dry on you, and it'll be really annoying, and probably start looking, at your television instead of this. Right now, this is the most important thing, I think, not only because we can help you by managing your money, or that this webinar can help you, but this is just important knowledge to understand for the rest of your investing career. They don't teach investing in school. They should teach it every year. One day I'm going to try to change that. Honestly, I'm somebody, and my whole crew, we're trying to change the world, and we hope people start looking at the investment world the way that it really does exist. All right. So this is the physics of the market. This is how it actually works. It's not my opinion in any way. All right. So it's telling you, it's by definition, it's telling you what is happening. I'm going to bring you over to something that's going to be a little bit more animated. Okay. I'm going to use for this NASDAQ Dorsey. And all you have to do is know your colors. So this might seem overwhelming or intimidating to some folks, but as long as you're familiar with red and green and yellow, you're going to be just fine. Okay, so You look at the dates here. You probably can't see it, so just take my word for it. Each one of these rows represents 2 weeks, 2 weeks of data. So 2 rows is what happened in the course of a month. All right, you can see January is these 2 rows, December is these 2. Well, in this case, it happens to be 3, but every couple rows is a month of data, a month of change. And you can see international equities here. These are the 6 major asset categories. You can see international equities is the greenest, okay? So forget the numbers and the math and all the wonky division and stuff. It's the greenest. If you want to take it another level down, look, it's ranked, it's got 243 buy signals in that matrix. Doesn't really matter what that means right now. It just means it's relatively strong. It means you would have rather had been in international equities than anything else because your account would have done the best. And these trends, they last a long time. Now, it might not seem like they last a long time just looking at this screen because you might notice a lot of color changes in the rows. You could see that international equities was green, then it became red as you go further up. And if you look over at domestic equities, you might notice that it was very green near the bottom. And as time passed, by the way, time passing is upwards. Okay, most recent row is the top one. This is most recent 2 weeks. But you might notice that U.S. stocks actually got a lot stronger recently. You might remember I said that a little earlier. I said that U.S. stocks had got relatively weak relative to some other things. When you look at this point system, basically when one thing gets stronger, it has to be at the expense of other things. This is relative strength. So if international equities jumps in score, it goes from 225 to 240 to 243, that means these other guys have to be losing some points. It's getting strong relative to other stuff. And in this case, for a few weeks, it was relative to U.S. stocks. It's interesting to see U.S. stocks gaining strength now. Commodities, look how green it used to be, right? As we go higher, it's more and more recent. But look at commodities. This is not to be confused with commodity stocks because they happen to be very strong right now. This is commodities, actual oil, actual gold, actual agriculture. And recently they got a lot weaker. Okay, so you don't need to know all that. I just need you to know your colors and just know that each row represents 2 weeks. So every 2 rows represents a full month because I want you to see how long these trends stay intact. Remember I told you that the cruise ship takes a long time to make that turn, but you're pretty certain once it turns and changes direction, chances are that cruise ship is going straight, give or take, right? I mean, that's the big trend. That's the long-term trend. So I'm going to scroll down now. Before I scroll down, I want you to know that this top line here is right now, it's February of 23. The bottom line down here is October of 2021. So I'll highlight about a year's worth of data right here. This is about a full year worth of changes. So if you look at these different asset categories, you can see all these things happen over the course of a year. And when you go through a crazy year like 2022, that's when there's lots of little changes here, like you see on your screen. When you go through a 2008, you'll see a lot of changes. 2011 was crazy, right? The COVID crash. So you'll notice that in 2020, you're going to see a lot of color changes. But for the most part, these things stay the same. So let's just look at domestic equities. It's right here in the middle, okay? And you'll notice I'm going to scroll up. It used to be ranked number 1. You can see it's the darkest green. In fact, here's what I'll do. I'm just going to change this from the score to ranking. So all these will adjust and you'll see international equities turns to a number 1. Very simple. These are just the rankings. You don't see the scores. So right now, international is ranked number 1. US is number 3. But I'm going to scroll down and check this out. Look how long domestic equities was ranked number 1. Right here, you've got December of 2021 at the top. All the way down at the bottom, you've got mid-2020. All right? Prior to that, there was a shakeup here, right? You see things started changing color here. These things the rankings were changing. That's because nobody knew what the heck was going to happen after COVID. So you can see this is the beginning of 2020 right here. And this is going into 20. So people were getting used to COVID and there was a lot of changes. People didn't know what was going to be strong, what was going to be weak. When you go through times like that, relative strength becomes tough. I'm going to scroll down some more. Look how long these rankings stay in place. International equities was ranked number 2, the entire screen. So that goes, the top is December of 2019. So the end of 2019, beginning of 2020. International equities was ranked number 2. And you can see the bottom here is the middle of 2018. So you've got about a year and change of data here. I'm going to scroll This is about 3 years. International equities stayed ranked number 2. US equities stayed ranked number 1. We looked at about 3 years of data. And then when you get to 2016, remember the elections? Nobody knew what the heck was Hillary or Trump going to be a very different outcome. You see all kinds of color changes here. I'm going to scroll down a little bit more, and you'll notice how clean it becomes again. So basically, relative strength trends stay intact for a long time. And this is not a prediction. This is basically saying today, if this is ranked number 1, probably it's going to be ranked number 1 for a long time. And what I'm showing you proves that. Again, it's not a prediction. It's not a forecast. The fact that it's ranked number 1 means that it has outperformed all of these other things. We're basically looking in the past. We're saying it has outperformed. It continues to outperform for years and years and years. This happens in terms of asset classes. It also happens in terms of sectors. So I'll just bring this to something that people are a little more familiar with, which is the US stock market, the major sectors of the US stock market. Let's do a custom thing again here, and then we'll open up for questions, okay? Custom thing again, going back to 2013. This is going to be the intervals I got to change also, but it's going to be domestic equities, so US stocks. I hope it doesn't reset when I go to these intervals. Good, bi-weekly. So again, every line is 2 weeks. So 2 lines, 2 horizontal lines is a full month. This is sectors. Right now, basic materials is ranked number 1. It shot up to the top. I'm going to make this rankings instead of the scores. And just remember, the colors are what's important, all right? 2022 was nuts. That's why you see lots of color changes here. It's crazy. 2022 was bananas. But when you scroll down and you go into, normal land, normal territory, you can see that technology here was ranked number 1. Literally, just take my word for it. It was ranked number 1 for 5 years, from 2016 all the way to 2021. You can see the worst pretty much stay the worst. The strongest pretty much stay the strongest. You stay diversified among the best. Remember, here's 2016 where things got crazy. See how crazy and colorful it is? And then prior to that, you had these nice, pretty steady strength patterns. So that's relative strength investing in a nutshell. And there's all these other caveats and all this other stuff that I can spend an hour or 2 talking to you about. But I'll tell you the basics. Every few years, you get a complete washout. Like something nuts happens and then it just gets washed out. You had the COVID thing. You had when Trump got elected. Prior to that, it was 2011 where we wouldn't, there's the argument over the debt ceiling, and then and Standard & Poor's downgraded U.S. Credit rating. Prior to that, it was 2008, right? Every few years, things go crazy. And then there's sort of a reset. And then it's like, all right, what are the new rules? What's going to happen? Now I'm talking major long-term trends, multi-year trends. So what are the rules of this one? Well, it looks, we've just gone through the washed out period and everyone's scared. Nobody wants to do anything. And then you realize, okay, the coast is clear. Everybody who's going to sell is pretty much sold. Now everybody's becoming more and more what they call risk on. So it's a risk on environment now. When you become more and more risk on, people start investing in these higher risk things and it becomes easier and easier to make money, becomes super predictable. International equities are considered a risk on sector. They're considered a above average risk sector. There's more volatility to the sector. Or to the asset category. And people are very interested in investing in things that hold risk right now. They have no problem investing in things that have a lot of risk. It's what they prefer. It's what they're looking for, period. And you'll see these changes happen because they happen very slowly. You'll see a cruise ship changing course. It's pretty obvious when a cruise ship is changing course, what its intentions are. International equities are where we want to be. Now, I have a matrix that I built of international stocks that I'm using, and we have an international equities model, and it's based on relative strength investing. And we've had it for a very long time, and you can call and get a consultation about it and everything. I'm not going to show you right now what's in the international model. You're going to get a pretty good idea based on what we're going to talk about after some Q&A. I'm going to dive into some details, and I'm going to give you exact ticker symbols that you can focus on. Now, we have one international equities model that uses exchange-traded funds. So we might buy you 5 exchange-traded funds. One might be Argentina. One might be Turkey. One might represent Greece and so forth. One might represent, Singapore. And we do this through an exchange traded fund. And what that means is it's highly diversified. These funds might own 100 different stocks. It gives you exposure to these other stocks without having to be registered a certain way. Long story short, what we're going to launch that's new for qualified investors. And qualified means you have north of $1 million investment. Sorry, it changed. $1.1 million investment portfolio with us, and that's going to be individual stocks. So we're going to have about 10 to 12 individual stocks that are international stocks. So it's kind of a subdivision of our currently existing international model. International model, way more diversified. You're going to have 5 exchange traded funds. You might have somewhere between 300 and 1,000 stocks represented in what we currently have. Okay, but you're going to be in the best of the best groups. So it's relative strength on top of relative strength, meaning we know that international equities are the strongest, but we're going to narrow it down to the strongest countries within international equities, and we use exchange traded funds to do that. But the new model for qualified investors is going to be individual stocks. Now, of course, you're going to see me share these individual stocks from time to time, but there's going to be very consistent rebalancing, as is the case with 90% of our models, where every month on the same day, we rebalance and we put you in whatever looks to be the strongest. Basically how you can get all the details on a consultation if you go to avalloninvest.com/consultation. This is very simply the link, avalloninvest.com/consultation. Hopefully somebody can just pop that in to the chat and schedule a call with us. See if we're a good fit. Again, we're different from everybody else because we are money managers. I shouldn't say everybody else, but I'm a money manager, and I'm wrapping an investment advisory firm around my money management. It's the opposite of what most investment advisory firms do. So, we save you a lot of money on commissions and fees and things like that because I am the money manager. I'm not paying somebody else. And I'm not just gathering assets and then whenever it goes wrong, I blame somebody else and then I switch you to a different person. Instead, the buck stops on my desk. I'm the one who's managing your money. I also want you to learn, to speak the language fluently, as is the case with, all of our advisors can speak the language. They understand how it all works. You'll get on the phone with me or, the Google Meets or the Zooms with me from time to time too. No matter what level of account value you have, I still tend to hop on from time to time, say hello, kick the tires, make sure everything's going well because it's my name's on the door. I'm going to go to the Q&A now. You'll notice on the right side there's chat and there's Q&A only. So I'm going to start with Q&A only. That's going to get priority with questions. How is asset class ranking determined? Rick, it's determined through relative strength studies. It's a very long story, but I'll give it to you very simply. If you want to know the relative strength of one thing versus another thing, like let's just say you want to know the relative strength of Microsoft compared to the software sector, like all software stocks. Microsoft is a software stock. If you want to know how well that's doing within its family, within its group, you're going to compare Microsoft to the software sector, the whole sector. All you have to do very simply, you create a sector. It's going to have a price to it, right? A sector index, let's just say, has a price, right? If you were to look at a chart, you'd be able to plot the performance because it has a price. And Microsoft obviously has a price. Very simply, all you have to do is divide the price of Microsoft, which is your primary, just divide that by the secondary, which is the sector index. That's it. And then you plot that every single day. If it's going up, Microsoft is outperforming. If it's going down, Microsoft is underperforming. So instead of a chart with 2 squiggly lines, you just have one, and the one line says if it's outperforming or underperforming. And when you do that, you can narrow down to very short-term zigzags or zoom out to the big trends. And when we manage your money, we zoom out to the big trends. I saw somebody asking, is this similar to what we do at True Market Insiders or Sector Profits? It's the same concept. Here, our focus is on the big, longer term trends. There, I go over all the trends, but a lot of people have more demand for the shorter term stuff. So I just do a lot of that there. Ernie's saying, is all this relative strength info also? Yeah, so I just answered that. I'm gonna go to the chat for a second. I'm gonna answer some questions there, and then I'm gonna start giving you some symbols to jot down. They're not recommendations. I'm just showing you that they are mathematically, relative strength-wise, the strongest. And relative strength wise means actually. All right. Make sure that you sign up with Avalon's free e-letter, which is Adapt. All right. Now I'm gonna give that to you here. I'm gonna actually put that in. I'm gonna put a bunch of links here for you. Let's see how that worked out. There's a bunch of links in here. Sign up for Adapt. You can get your risk score. There's a model, a VRM model. There's a whole bunch of stuff I'll put in the chat and I'll put in the Q&A. Looks like you guys are holding off on the questions and stuff. I think maybe you just want me to get to the symbols. Do I read you right? You just want me to show you show me the money. What are the winning trades? Is that what you want to see? Because I'll do it. I'm not afraid. I'll just dive right into it. All right, hold on a second here also. So just real quick, and then I'll get to the symbols. So the final thing. All right, I'm just going to tell you, I've got some notes and I want to make sure that I cover everything here, okay? First of all, clearly international equities are the strongest. They just did something I haven't done since April of 2010. They outpaced cash, US equities, commodities, everything. They moved to the top spot. They haven't done that since April of 2010. So this is not something that is a flash in the pan and then goes away real quickly, okay? So 2010, you might remember, it became very strong. And that's when you're coming out of kind of the rubble of a horrible, market that was coming out of 08, 09, right? So April 2010, they became strong. Imagine that, even in the face of you remember, the Eurozone and Greece was just an absolute mess. Just take my word for it. Turkey bottomed out in July. Greece, all these countries, they bottomed out in the middle of the year or earlier. And Turkey's up it hit a high, being up 130% off of its lows, to tell you how far along they are relative to the US stock market. All right, up 130% off of its lows. I know what a lot of you are thinking. It came too far too fast. It's too late. No, well, remember how long those relative strength trends last? They last years and years. And if they cease to exist, the good news is we're not flying to the moon for a couple years. We're on top of it every single month. So as the trends change, we see them and we rebalance here. All right, we're going to get down to the nitty gritty, and we're going to talk about the best place to, there's going to be a bunch of different matrices, which is plural for matrix. We're actually going to go into two matrices right now. All right, so let me pop you over to the right screen. And this is where you're going to want to take notes. This is where you're going to want to maybe screen grab. This is where, this is a specific algorithm that I have programmed here. And I'm not discussing the fundamentals of these companies. Some of them will be, lower volume. They'll trade with a lower volume. You want to watch out for stocks that trade lower volume sometimes. But sometimes it's because they're an American depository receipt, an ADR. So if you look at number 18 on your screen here, and it just says Perion Network Limited, it's in Israel, and it says ADR after that. That stands for American Depository Receipt. Not all international stocks are ADRs. Okay, so an ADR just means they've created a way for you to trade this stock on a US exchange without having to trade it on a foreign exchange that you don't have access to. So it gives you access to this stock through a US exchange. That's an ADR. So therefore, when you look at PERI, number 18, or if you look at number 14, BBAR, you'll notice that they might have very light volume. It look like there's no volume, like nobody's trading it. But overseas, it might have a lot of volume being traded. So take a look for that ADR. Whenever you see light volume, just look at the name and see if it's an ADR. Now I'm showing you the top 20 out of about 190 stocks. All right, now this is mathematic. I've screen grabbed this right before we started this, okay? These can change. This is like, the way to think about this is kind of like a sports figure. LeBron James is probably not going to have a bad year next year. Might not be as good as recently. So that when you're investing in relative strength or momentum strategy, what you're saying is whatever has been performing really well is probably what's going to continue to, or at least when you look at this list of 20, I'll bet you about 15 of them are going to be here next month. or at least 13 in 2 months. Probably the same 10 will be in the next like 6 months or more. You might remember when I recommended TUSK or NINE, and then after the midterm elections, they were the strongest oil service stocks in the oil service sector in the U.S. They still are the strongest. So these things last a long time, and it's been like 3 months since then. Okay, so this is 20 of the top out of about 400, maybe 390. I know I told you, I divided it in half. I know I said 190 earlier, but combined, these two make up about 300 some odd, like 390 different stocks in the study. And so consider these to be the top 40. The two screens that I'm showing you right now are the top 40. All right. So if you want to screen grab this, I have switched the screen. You might notice the technical attributes on the next one, on the second one. In this case, we want to consider also the technical attributes. They were cut off from here for some reason. I apologize for that. But either way, if they have these buys versus X's, if you look at these two groups here, these two vertical columns, buy is longer term relative strength. X's is shorter term relative strength. So you might notice that ATIF has 164 buys. So long term, it's stronger than, remember I broke this in half. So it's about 190 stocks in this study. And this is stronger than about 164 in terms of the buy signals, long-term signals. But in the short term, it actually underperformed a lot more, right? So it's down, it only has 77. Consider that compared to DGHI, which on a long-term basis and on a short-term basis is outperforming. CNEY, long-term basis and short-term basis is outperforming. All right, you'll notice that. Now this one is a little bit more shorter term of a matrix. I calculated this just a little bit differently. This one has a little bit more of a shorter term focus. I should label that. I'll do that in the edits. You see what happens. You get to have the live questions, and then, but these are individual stocks. Now, some of these are going to be in the new model that I'm going to launch that has individual stocks. There's going to be about 10 to 12 individual international stocks. And these things are going to, I can't say what they're going to do because I don't know what they're going to do, but they have the potential to be like 3 or 4 times as explosive as the best stocks in the US stock market. These are the best stocks considering many different international markets. Okay, these are not just Europe, this is not just Asia, it's not just Israel, it's not just the Mideast. This is, you can see here, Manchester's here, China's here, there's Taboola, which we use. These are individual stocks that have way more upside. Some of these are going to be funky and weird, and the chart's weird. If you don't understand it, don't invest in it. All right, but we're going to weed out a lot of these, hardcore study all 40 of these top players, and we're going to put them in a model, and we're going to let that model ride, and we're going to rebalance it every month. So it's going to be a rules-based model. It's going to be rebalanced every single month. I'm going to have a program that's going to tell me what to do. And even though it's telling me what to do, I'm going to look at it very closely when we do the rebalances, as I do with all the models. So all the models I have programmed at Avalon, I look at the rebalances, I go over them with my team, we talk about all of them. 19 times out of 20, we don't mess with it. We just do what the rules tell you, to do. But if there's something weird or there's too much overlap or something, we're careful. Speaking of not always following what the models do, I want to be very clear on something because we get a lot of inquiries about this in terms of our, following the models religiously and very strictly. There are times where one model, this is really, really cool. There are times where one model will basically put us on alert on all the other models. So in March, we had something that rebalances going from February into March and then from March into April. And we notice a signal. And the signal of one of these models, which is called our volatility resistant model. Now, one of these models gives us a particular signal. I'm not going to bore you guys with the details, but it tells you to get the heck out of the way. That's it. A train is coming. Just get the heck out of the way. You're better suited just to get the heck out of stocks and bonds. Just get out of the way. And we start checking everything else and confirming what's going on. We see more bonds leaving the market in terms of outflows than in I forget however many years, like the 50s or something. The bond market had the worst time after that since like the 1800s or 1700s, something crazy. But it told us to get the heck out of the way. So we sold all stocks and bonds. There were a couple exceptions where clients said, whatever you do, don't sell my Apple or whatever, right? So we tagged that. But aside from that, everything I'm allowed to sell, we sold all stocks and bonds. So keep in mind, we have these different models. Some of them called for maybe still 10% in stocks and 20% in bonds. We got the heck out of Dodge, sold all stocks and all bonds. We got the signal to do this on April 13th. If you look at the charts, it's at a high. So I'm like, there's a downtrend, but it's a high within the downtrend. Saved everybody a lot of volatility, saved everybody a lot of, misery and complete panic. A lot of people would have sold at lows. So every now and then, that we saw that signal two other times. One was, in the early part of the COVID crash that told us the same thing per that model. And right before the market crashed in 2008. So we got out of the way again. For the stock market, it crashed another 15+%, and we avoided that, which is an 18% outperformance. Long story short, who the heck knows how often, we just pull the plug and say, I don't care what you're saying, models, I'm going to get out of the way. Because even better than outperforming everybody else because your stuff went up by more, even better than that is standing out of the way right before a disaster happens and then getting back in. Our clients felt that. I'm not saying we're always right, and you're definitely I guarantee you're going to go through some underperformance sometimes. Guarantee you're going to dislike us sometimes, 100%. But it'll be like having you dislike a family member for a short period of time. And, we make sure we get on the same page, we communicate the right way and make sure that most effective way of avoiding any kind of bad feeling is to have a really strong understanding of who you are and who we are before we even begin our journey. And we adjust as needed, but we want to try to really hit that mark initially. All right, we're going to get into some more stuff here. Quickly go to the Q&As. More recent Q&As are international markets on top because U.S. equities have taken such a hit in the past year plus? Both of them, Martin, took a hit when the market got all crazy. International equities hit their bottom much earlier than the U.S. market. So this is a good time for me to pop over to Thinkorswim and show what I'm talking about. All right, here's the U.S. stock market. And here's the first bottom, which was really June 17th. And remember, because it was my birthday, we were celebrating on the beach that night. And here's the second bottom in October. Now, right around here in November, I started telling everybody, basically, this is exactly what's going to happen. I said the market would bottom out in June, likely rally, bottom out in October, new bull market, right? This was a textbook market. But remember this, June right here, October. Again, June is the first low, October is the second low. Now let's look at Turkey. It's a little different. Let me get rid of those confusing indicators if you're not familiar with that. All right, now Turkey, it made a low way back here, 2020. It went, this ETF went from about 18 up to about 30. So, like 60% gain, right? This just goes to show, this is emerging Europe. This just goes to show how much more volatile these markets can be. And, don't let that steer you away. To control your volatility, we just put less of your allocation into these types of things. But you wouldn't, think about it. You might not even know what you missed from 2004 through 2000, to the high and beyond. You remember the BRICS, first it was BRIC, which was Brazil, Russia, India, China, right? Those were the big markets. And then they added S for Singapore. So it was BRICS. And then they have all these acronyms. But if you missed that, you were in the kind of the weaker market, the US market for some time. Look at this big dip right here. Now, this is at the turn of the year, 2021, going into 2022. Now, you might remember the US stock market, right? 2021 going into 2022. look at what was going on. It was the top right before a bear market, right? That was going into 2022. But look at Turkey, TUR. At that same time, Turkey was hitting its bottom and beginning this ferocious bull market. Now, it didn't go straight up, right? It bottomed out here in March, and here's the bottom in early July. So we bottomed out in the US in the middle or late June, and a couple weeks later, Turkey bottomed out, and off it went into its new bull market. And you might be saying, well, look, Chris, how do we know it's not just gonna, it hit its bottom? Like, this bottom seems pretty horizontal, right? You see how this bottom here is kind of horizontal. It bounced, went a little bit higher off the second bounce, went a little higher off of the third bounce. And then you're saying, well, Chris, how do we know it's not gonna come all the way back down to here? And the answer is you don't know. However, you have to consider the relative strength readings that we spent the first half of this covering. And when you see the relative strength readings, that it doesn't really matter. Everything that you're looking at you're looking at this in terms of a dollar. So this is 31 relative to a dollar bill, right? But when you compare that relative to the value of art, or the relative to a baseball sports card, or relative to the value of your television, there's all these different relative relationships. You think about the currency market, you've got the yen compared to the euro is one thing. The dollar compared to the euro is another thing. You might have the dollar compared to the pound, or you might have the dollar compared to the yen. There's relative relationships, and that's the way everything works. So when you're looking at this, you don't need to know all this stuff, but we do. When you saw that ferocious gain in terms of relative strength readings, we see that international, especially emerging Europe, is very strong. I'd be a buyer of TUR here. GREK, which is Greece, for example. I'm looking at emerging Europe now. Look at how it's broken out. It's moved on to a new high. Similar to the US market, right? It bottomed out where COVID bottomed out. It hit its top, went sideways for a while. I'm going to look at the Russell 2000. This is US small caps, right? Bottomed out COVID. This is the US small caps. Hit its high in early 2021, went sideways, and into 2022 is a bear market. Greece looked a lot more like that. So GREK, again, bottom COVID, top flat throughout 2022, bottom. But the difference here is that, instead of June 17th, you got July 4th, almost the same bottom. And then here in October, a little bit earlier, right? And then look how big the gain is to the upside. This is a market you want to buy on the dips. It's broken out of a new all-time, I don't know, is it an all-time high? I don't even know. But SPX, look at the US stock market compared to Greece, and we're still far from our highs, right? So Greece rallied off the same two lows, rallied off of June, July, rallied off of September, October, and Greece has broken out and broken up to a new high. And that should tell you something about its future. The fact that it can achieve that when the US is sort of in this Biden bull market is a real tell, and kind of breaking it down to a little bit more simple terms for everybody. Again, sign up for a consultation. The links are in the Q&A. Sign up for Adapt. Make sure that you are with Adapt. But sign up for the consultations at AvalonInvest.com/consultation. Miguel says, so which moving averages are the best ones to follow for sectors relative strength? All right, well, keep in mind that moving averages are kind of like a level below. Moving averages are the raw material for momentum. They have a start date, they have an end date, okay? It's a little different. Relative strength is a little more sophisticated because it takes one and divides it by another. So it basically goes into kind of another world, and then it gives you signals earlier to get in and out. When you're working with moving averages, you're still in terms of momentum, which is, still great, just not as sophisticated as relative strength. And, you got to use moving averages to figure out momentum. It's different from relative strength. So just instead of being too rigid, Miguel, just think in terms of bigger signals or smaller signals, right? If you can zoom out to a 20-year chart and you see the signal happening, it's a longer term signal. Sure, it might have happened in the matter of a week. If you zoom out to a 20-year chart of the US stock market, you'll know where the COVID crash happened, even though you zoomed all the way out. That's a long-term signal, even though it happened in a short amount of time. So the rebound off of that low is also a long-term signal saying, okay, don't worry, the mess is over. Yep, cool, got it. Let's see. Rick says, can you tell us what the signal is? I'm not sure what you're referring to. If you want to re-ask with a little bit more detail there. Miguel says, what time span is the best to track the highest sectors of the markets? Probably highest relative strength. 1 month, quarterly, every 6 months. I'll tell you, Miguel, again, instead of thinking rigidly, think very small signal, big signal, and a big signal that you can see from a zoomed out chart. The idea is if you're using momentum, you have a start and end date, right? So I think what you're asking me is like, should I look at the performance over the last 6 months and gauge what's strong based on performance over the last 6 months? Or should I look at the performance of a group of stuff over the last 12 months, which is going to give you a different list of stocks, but a lot of the same stocks overlapping? And the answer is, if you have a longer term outlook, like if you're a long-term investor, you might be basing that on, 9 or 12 months of history. If you're a shorter term, you're probably looking more at the 6-month history. And then if you get to the 3-month, you're getting a little too, you're kind of very close. And the shorter term your focus is, the more random it is. The longer term your focus is with the bigger picture, the bigger signals, the more likely that trend is here to stay for a long period of time. So that's the best way for me to answer that question. Cool, Carol. Rick says you mentioned there was a signal you saw to get you out of stocks and bonds in April. And your question is, what signal did I see? Well, there is it's the VRM model. So if you scroll down, you're going to find a link. It says VRM model. And we're not going to get into exactly the algorithm. It is proprietary, and I'm sure you can understand why. When you click on that link, you're going to see the performance of that model. Okay, I'll put it here again. I don't know why that word edited is there. I kind of just had a bunch of notes and copied and pasted and stuff. So again, this is the no frills version that you get because it's live. But if you look, I put this link there, avaloninvest.com/VRM. Okay, avaloninvest.com/VRM for volatility resistant model. And if you're an investment advisor and you're watching this, you want your clients in this model. I'm not asking you, I'm explaining to you that you want your clients in this model or one of our other models. But look at the performance of this model. In fact, let's do a little, I'm gonna bust it out right here. Look, we're getting a little off topic, but not really, because this model has two sleeves where 60% is some sort of fixed income and 60% is some sort of stocks, equities, like international equities or US equities, and 40% is some sort of fixed income. Now, it could be 60% stocks, 40% bonds, or one of those sleeves or both of those sleeves could be empty, meaning cash or a cash equivalent. So it could be 60% cash, 40% fixed income. It could be 100% cash or cash equivalent. But basically, it's a 60-40 split. 60% is either going to be stocks or cash. The 40% is either going to be fixed income or cash. And we do some momentum stuff, and it's pretty short-term focused. And with that short-term focus, we noticed something over the last few months that's, just mathematically said stocks and bonds, in other words, equities and fixed income, are both underperforming cash, which in layman's terms means both are down, right? I think underperforming cash because cash is just an asset class, but both are down basically in a period of time. Now, when that's not the case, you'll have maybe 60% stocks or 40% bonds. And from that point, we have a whole universe that we select from. So right now, the 60% that's in stock, it chose an exchange traded fund that is an international stocks exchange traded fund. So right now that model, 60% of it is international stocks. And it's an international stock fund that's outperforming other international stock funds. So it gets you 60% into international stocks. And 40% right now is in fixed income. It's in the best performing fixed income fund. So best performing stocks globally, best performing fixed income globally. That's the model, and it's the volatility resistant model. Now, when you look at let me show you this. This is the bonus track. You're going to get the bonus track here. Let's find that. Let's find that model. Got a lot of things open here. Volatility resistant. Let's go. And we recently kind of redesigned this a little bit, so it's a little cooler. Might be a little bit, I'm still kind of getting the hang of it. But what you have to know when you're studying this, you're going to click on the link. You can do this on your own time, but I know you're going to do it on your own time, but listen to what I'm saying here for a second. There's three colors, right? Purple, gray, black, right? Purple, gray, black. The middle one, the gray, is what we should be comparing our model to. Because the middle one, the gray, when I hover over it, it only shows the gray, right? When I go away, it shows everything else. Pretty cool, huh? Thanks, TJ. Everybody say thanks to TJ. You hover over it and it shows the return of whatever that is, okay? So the gray one is what we should be comparing the model to. Reason being, this model is 60% equities, 40% fixed income. And the gray one is a benchmark that is 60% stocks, 40% bonds. It's a very famous benchmark for a 60-40 split. 60% stock, 40% bonds, and it's just a benchmark. That's it. It's kind of like a buy and hold, 60% stock, buy and hold, 40% bonds. It's the closest that you're going to get to a benchmark for this model, because the model, after all, has 60% stock, 40% bonds, but it can also have cash. And that's the cool thing. This model outperforms most things that you're going to compare it to, not only because it does better in good times, but even more importantly, it sidesteps the disasters. So let's take a look at the purple. This is the performance of the model over the total, period that we study, which goes back to 2007. So it goes through the '08 crash and all that. We went through a few cycles. Also, what you want to notice is on the right side, the drawdown. The definition of drawdown, that means the amount by which it declined before making a new high. So if you have your account, right? Your account's worth, let's say $100,000, right? Your account goes from $100,000. Before making a new high, it goes down 30%. And then like 6 months later, it breaks a new high. The drawdown was 30%. So the most that it declined before making a new high, that's the drawdown. And notice, compared to that benchmark, our model had a much lower drawdown. So this benchmark had a 32% decline, just a buy and hold, 60% stocks and bonds. Our model had half the drawdown approximately, okay? Approximately half the drawdown. But look, it outperformed more than, about 3 times, whatever that is. So it went up 459% instead of 120%, which is a slightly better gain. I mean, from where I'm from. Half the drawdown, way more than twice the returns. 459% instead of 120%. All right, we'll skip the black one. I'll talk about that in a second, but check this out. Here you can grab this and you can study it in any time frame you want. You can see how did it perform during the COVID thing. You can have your start and end date the way that you want it to. By the way, our model is the purple line. So remember the COVID crash, how everybody was going crazy and everyone's scared? Look what the purple line people did. Oh boy, I'm so scared. Look what it did. It just kind of went flat, down barely, and then up. That was through the COVID crash. Let's look at 2022, right? 2022 was scary, right? Come on, let go. Let go. Let go. All right, 2022, scary, scary. So this was the big scary time. Yeah, we saw a decline in the beginning of the year, right? So this is January 2022, and here comes March of 2022, and then going into April. That's where we got our signal. This model said, hey, get the hell out of the way. And we listened to this model and it kind of applied it to the whole firm. Everybody sold all stocks and bonds, unless they specifically said not to, but we basically call the shots here. And look how it was flat while everybody was losing their mind. It's down barely because it was a cash equivalent, SHY. It's down like a couple percentage points. All right. But look during good times, how it outperforms. Look during the good times, how it outperforms. Now let's look all the way back to 2007, 2008. That was an interesting time frame, right? 07, 08. So look at the 2007, 2008 thing. Told you I was getting off topic here, but this is such a cool model. If you're an investment advisor, call us, get your clients in this. All right. So coming out of 2007, the stock market was hitting its highs in 2007. And then look at, the benchmark we should compare it to, the gray one, went down, and the black went down even more. Again, this is into 2008. This is into the crash. And then I'll show you coming out of the crash. Okay, so minimum drawdown. Now, the black, that's the S&P 500 total return. So it's not even the S&P 500. We shouldn't compare this to the S&P 500. We really shouldn't compare this to the S&P 500. But everybody likes to for some reason, so we did it. And we did you one even better. The S&P 500 total return index is different from the S&P 500. The S&P 500 total return index automatically reinvests the dividends paid out so that you get a cumulative compounding return, because those dividend checks, instead of being mailed to your house in your mailbox, immediately go back into your S&P 500 investment, making it a much, 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 much bigger return. However, our model still outperformed it. It's not even a fair comparison because the S&P 500 is all stocks, and the stock market, is superior to everything else there is. All other asset classes, the stock market performs the best, but still this model outperformed it. So look, there's all kinds of things that we can do here. The most important part about this model is the drawdown. And if you look here, our model is the purple one. This is probably the most fascinating thing for me, is when you look at this drawdown. When the stock market crashed from 07 down to 2008, this model that we had here had a drawdown of about 8%. And it didn't have a bigger drawdown. It just stopped. It was in cash. While everything else, the S&P total return went down 51%. The all world balanced 60-40 went down 32.23. We went down 4.48 at that point. So you see the drawdowns here are very, very, very low. And that's why I can't give away the algorithm, because, this is the kind of algorithm that maybe some of you would hold me ransom for in a cave somewhere until we gave up the codes, right? And let's see if there's any other questions here. I hope that you guys look. There's a nice button right here, schedule a consultation. It's very easy. You click the button, schedule a consultation, and then it'll show you where we're going to have some time available for US, whatever your time zone happens to be. You click continue. I want a 60-minute thing. You click continue, and you say, okay, I see on the February, let's say Valentine's Day, you don't have a Valentine. You'd rather spend your time talking about financials. And then you just pick a time. It's very simple. And then once you pick that time, you just tell us, give us a little heads up, what's it about? What do you want to talk about? How you doing? Stuff like that. Test. And that's it. All right, guys, let's see any other, before we wrap this up, I'm just gonna, when we do the edit, we'll do a nice slide on the wrap up and everything like that. This time I'll just peace out, and you're dealing with real people here. We're not hiding behind some, teleprompter here, pretending like the Wizard of Oz. We're actually the inverse of that. All right. We are actual veterans of money management and risk management and this investment approach. The people that I work with, that I've surrounded myself with, are all students of this same investment approach. We're all speaking the same language. Thank you very much for your time. It's been a pleasure. And remember, all of the links are in the comment section. But avaloninvest.com/consultation is probably the most important one. Thanks everybody for your time. Chris Rowe, Avalon Invest. We are here for you. You'll always see it in the price before you see it in the news. Take care. Let me pause here for a second. If you're an investment advisor and you follow what I do, if you follow my framework, if you have a general understanding of it even, and you're an investment advisor, you're looking to link up with a super strong team, I will tell you that there is a chance that we can join forces in some way. We can absolutely do sub-advisory agreements with you. We can manage your clients' money for you. And be very friendly, and never compete with you or anything like that. But if you're an investment advisor and you're into what I do, I'm looking for you. So I'm reaching out and trying to find you. I'm trying to find investment advisor reps that are into this stuff, that think about the markets the same way we do. Now, the way that my investment advisor reps at Avalon work, they understand all the stuff that I'm talking about, but their main objective is to manage with the relationship and make sure that the client is in a volatility situation that they're comfortable with. All right, we're investing in relative strength, period. We're going to adjust you the way that it should be adjusted. It's a very great system that we have here at Avalon. It makes everything work. It's not cluttered. It's very, very clean. And we can still customize, even though we have models, we can still customize it to the client's liking. So if you're an investment advisor and you think it'd be a good idea to join a group where we actually have people just signing up because they know who we are, and we hand you the relationship, and there's very few people that I work with. I have a pretty small circle, and I'm not looking to conquer the world and become Fisher Investments. Okay, we're a very specialized group. If you think you have what it takes, reach out to us at info@Avalon Invest. And yeah, I kind of paused there. Oh yeah, so this is what I wanted to say.